Evening, everyone, or maybe good afternoon, depending on what part of the country you're in. My name is Jason Maida. I'm with American Pacific Mortgage. Welcome to our Virginia Alumni Association Homebuyer Workshop. Great to be with all of you today to learn a little bit about home buying. I appreciate you taking time out of your busy schedules on this Wednesday evening or afternoon to join us. We promise to bring a lot of great content to you to help you as you kind of think more about making that major decision of purchasing at some point in time. Our class is being recorded today, so we're going to record all of today's content. We're also going to share back with you all of our slides that we've presented today. And of course, as part of our discussion today, we encourage you to ask questions of us. So you can either use the Q&A function in Zoom. I'll be monitoring that, as well as the chat feature. Also be checking out for questions. So if you do have any questions based upon some of the topics we're covering, please feel free to use one of those tools. And as we get started for our class today, it would be great, since we have a pretty wide audience in terms of where we're at and located in the country. It would be great to kind of just to start us off, if you don't mind putting in the chat where you're either joining us from or where your intention is to buy. That would be super helpful for me, because we're going to talk a little bit about the housing market tonight and kind of see what's going on with it. We can also kind of go into a little bit localized markets, but if you want to kind of share with us where you're thinking of buying or where you're at, that would be great. It was kind of interesting. I was working with one of your fellow alum last week, and that person happened to be residing in LA, but looking to buy in Vermont. So it really just depends on where we're thinking our goals are for home ownership. So, we appreciate any type of feedback on that. Well, this is a class that we provide 4 times a year. So it's offered once a quarter through the Alumni Association. We get a lot of great participation of it. And our goal here is to just help provide you some just resources and support on that journey towards home ownership. So you're going to learn a lot of great things to help you attain that goal of home ownership. And we want to be a partner along with you in this journey. Our organization is called American Pacific Mortgage, or APM. We're the 9th largest company, mortgage company in the country. Our team in particular, we specialize in providing educational services to help provide you those tools to help you on this journey towards home ownership. So I teach classes just like this over all across the country. We'll have over 10,000 people signed up for classes this year. So really excited to really present information like this in our localized communities. All right. And then our talking points for tonight look like this. So we're going to spend some time talking a little bit about the housing market, what's going on with it, also kind of how that correlates with what's happening with interest rates and some of the economic data that's coming in right now. I think it's important to kind of share with you what's going on currently with interest rates, but also kind of projections with interest rates. We're also going to take a look at, does buying make sense for me in terms of how does it correlate to my current rent situation versus what could it look like if I decide to purchase. And so like kind of a buy versus rent calculator that we'll jump into in the next couple minutes. We also want to spend some time looking at credit. Credit can be one of the most costly things to home ownership. So I want to give you some just tips and tricks around credit. We'll also look at loan programs that are available to you as a buyer in the market. And we'll also talk about kind of some of the features and benefits of each product. And then we'll look at savings for home ownership. Now that tends to be one of the bigger challenges for most of us pursuing home ownership is, how do we basically save up enough money to get me to my goal of home ownership? So we'll walk through that, as well as some of the documentation that we generally would ask for as we validate what you've already kind of accumulated in assets. And then we'll look at first-time home buyer programs specific to localized markets that could help support you with different resources to meet some of your down payment and closing cost goals. And then I want to walk you through the workflow of buying a house. So, after we leave today's class, you may want to learn a little bit more about how do I get started to build my own personalized home buying plan. We'll help you take those next steps this evening to help build the kind of framework, if you will, for home ownership. All right. So that's our plan for tonight. Those of you that did get a chance to respond in the chat, thank you for that. That kind of helps us to kind of get a sense of where we want to purchase, because we are a nationwide lender. So we can certainly help any of our students that attend our classes in every market across the country. All right, so let's talk a little bit about home buying. Does it make sense for me? Obviously, you're considering this to be a major financial move because you're obviously taking time out of your Wednesday schedule to listen to me for an hour. And so in doing that, let's think a little bit about home ownership. It does create the opportunity, create a little bit more stability for ourselves with our expenses or our housing expense. Because right now, if I'm a renter, I'm just at the mercy of the landlord increasing rents on me every year, right? Well, now when I'm a homeowner, I have the opportunity to kind of control my monthly budget. Now, we all realize that interest rates are elevated in today's market, but some homeowners, or when they become homeowners, will have the opportunity to refinance to a lower rate at some point in time. Now, this is an asset, and for most of us, it's the number one asset that we own as homeowners. And that asset should grow over time. So as the value goes up, as I pay down my mortgage balance, that difference in those two figures is called home equity. And like I said, for most of us across the country, it's our number one asset. It does have the opportunity to create generational wealth for families as well, too. And in being a homeowner, we want to put into our calculation the benefits of tax deductions with homeownership, potential tax deductibility of interest on my mortgage. Also, when I decide to make energy efficient improvements to my home, that can also create tax benefits for me as well. So I always encourage our class when we're thinking about building our plan for homeownership, we don't want to necessarily say, okay, I'm paying $3,000 a month in rent, so probably I should be paying $3,000 in mortgage, because ultimately we want to put into our calculations all of the great benefits that come along with homeownership, equity appreciation, tax benefits, so on and so forth. To help kind of frame that up a little bit better for our class, I want to walk you through one of our available tools that are online to you. And that's called our rent versus buying calculator. And essentially what that can do is it'll show you the comparison of continuing to rent today versus what could it look like if I decide to purchase a home at some point in time. So this is what the tool looks like. I'm going to walk our class through it really quickly. And then, as I mentioned, as we launched into tonight's class, we're going to send out all the presentation material to you tomorrow morning. We are recording tonight's class as well, too. So if you miss anything, got to step away from your computer a little bit, we'll get you, or you'll be able to kind of get all this content back to you tomorrow morning. So this is what the calculator looks like. So we just kind of put a what if scenario of a $450,000 purchase price of a home. We have the minimum down payment for a conventional loan, which is 3%, which would translate to a loan or amount financed of 97% or $436,500. We put an average interest rate plugged in for the loan. That may be higher or lower depending on where the market's at. We have a 30-year fixed term of the loan. So that's 30 years amortized loan. And then we have the assumption of when I'm going to buy. So just for today's conversation, let's put actually today's date. So we have October 1st. We have mortgage insurance, because when we put less than 20% down to buy a home, we are going to have mortgage insurance. We have homeowners insurance, which would cover our home against any type of peril, whether that's fire, could be flood, burglary, whatever the case may be. Taxes that are estimated on my home. If I'm going to buy maybe a condo, maybe I'm looking at townhomes or some type of planned community, I probably have HOA dues. We're not going to put that in this scenario. And then we're going to have tax information that we're going to put in. What tax bracket am I in? Am I at the 25% tax bracket, 26, whatever the case may be? We have the cost of maintaining my home, how much it's going to cost me to sell my home at some future date. And then how much is my home going to go up in value? What will my home appreciate at? Now, depending on where you're going to buy in the country, appreciation rates look a little bit different. Obviously, the housing market can cycle at times. And then we have comparing that to someone that's paying $2,000 a month in rent, along with renter's insurance costs, and then their rent going up 2% on an annualized basis. Okay. So the inputs obviously will look different for everybody in class, but this can give you a really great idea of looking at comparison of the upside benefits of owning a home versus renting. And for some of us going through this calculation, it might make more sense to continue renting because we have a really good deal and it meets all of our lifestyle benefits. But for many of us attending a class like this, looking at a calculator can help frame things up a little bit differently for us. And so, in our scenario here with someone buying a $450,000 home, paying $2,000 a month in rent, which is probably the norm for many of us, we have a break-even point after 4 years. So what I mean by that is if I decide to go down the path of homeownership versus continuing to rent, I'm going to be on the plus side of owning after 4 years. So meaning after I look at my home possibly appreciating, after my investments of down payment, comparing that to rent, my break even's 4 years. But if I look even further out, so I cast my calculation out to, let's say, 10 years, I'm going to have about an $82,000 opportunity of owning my home versus continuing to rent and probably paying someone else's mortgage, right? So this is a great way of kind of analyzing home ownership for yourself and maybe thinking a little bit further about what your monthly budget looks like. I would encourage you, if you have some time, dive into that calculator. I think you'll find that exercise to be a really great kind of launch point, if you will, for home ownership. All right. So that's our rent versus buying calculator. Now I want to kind of pivot a little bit. I want to talk about the housing market. Lots to share with you there. In many markets, we're kind of now going through the seasonality of the market. So, the weather's starting to change. We're in the fall season, right? It may change buyers' activity levels because not as many people want to go out shopping as the weather gets colder. Maybe as many sellers are not putting their homes on the market. I will say there is, in most parts of the country, a backlog of supply that's out there. Many parts of the country have almost 2 months of inventory or more. Other states have more inventory, and I didn't see anybody in the chat looking in these states, but Texas, Florida, Georgia, and then we have Florida, Texas, Georgia, are all some of our highest inventory states in the country. Okay. Oh, Colorado. Sorry, I'm missing one of the states. So there's 4 states, and Colorado's our other one. So, we're seeing a lot of inventory stack up in those states. Now, we are seeing trends, obviously, in interest rates that we'll talk about that are going to probably fuel some buyer activity, especially in generally what we see is the slower months of the year. So fall and winter, especially wintertime, tends to be slower in most parts of the country. As we get into the warmer months, spring, summer, that's when we see higher activity levels in market. But this is kind of a weird market right now. It's trying to kind of find its footing, if you will. This is a 3-year look back at the housing market for the Virginia housing market. You can see we're having a kind of a little bit of downtrend in price right now. That can be a product of just oversupply in the market, not as much buyer demand. So, sellers are having to make price reductions, make seller concessions towards the buyer to help maybe make their property more appealing to a prospective buyer. And we're seeing many parts of the country that are giving seller concessions. And so essentially what a seller concession is when the seller is either reducing price or essentially providing a credit to the buyer to offset some of their expenses. We call those closing costs. And you'll hear more about that later on. Across the country, 44% of all transactions being done have some type of seller concession involved in them. All right. Now I'm going to just quickly pause here. I want to take one of our questions that came in, which is what percentage of people typically put, what is the typical percentage people put down, or what is the necessary percentage when it comes to winning bids in competitive markets? So, most of our clients, because we primarily work with first-time buyers, are probably putting somewhere between 3% to 10% down. Some buyers are very fortunate and they have a good savings or nest egg, or they have family members that can help them get to 20%. But every market's a little bit different. I do see this market shifting a little bit in some of our hyper-competitive markets where we're seeing rising prices, really challenges with affordability. There are many more buyers putting that 10 to 20% level. But as you're going to learn a little bit more in our products segment, the minimum down payment is 3% for a first-time buyer. All right. Okay, so as I mentioned earlier, what's kind of driving some of the buyer activity levels is interest rates. We're finally getting some good news from the interest rate side of things. The Federal Reserve 2 weeks ago today cut interest rates 0.25%, and everybody's excited about that. Obviously, borrowing costs are coming down, which many of it we predicted already. So we always kind of had that baked into the market. Mortgage interest rates will generally fall as a precursor to the Federal Reserve cutting rates. So we already kind of saw a lot of that baked into the mortgage rates leading up to the announcement 2 weeks ago. Now, what we also looking at really carefully is the Federal Reserve gave some indication that they could see or make 2 more rate cuts this year. And this afternoon, or this morning, I should say, we had some softer than expected numbers come out from ADP on payrolls, and that actually sent a nice little improvement to the markets. Now we're going to be watching really importantly what unemployment numbers look like on Friday. That could be a market mover. So we're seeing that the Feds could make another move with rate cuts. And as we get more clarity on that in the mortgage space, that will bring mortgage interest rates down. You can see, we're not quite at what we reached at the 12-month level lows 2 weeks ago, but we're getting back to that level based upon the improvement today. So, the markets are really watching carefully what the next move is by the Federal Reserve. So average interest rate today sits around 6.25%. You can see kind of our 12-month look back here in interest rates. I think it's important to understand as a buyer, like interest rates do cycle. We unfortunately happen to be in an elevated cycle today. It's not the highest we've seen by any stretch. If I go back to October of 23, Interest rates elevated to like 7.5, 7.6 levels, actually almost touching to 8%. That was kind of a scary day. But interest rates have drifted lower. As we look back at the last 25 years of interest rates, you can see these cycles of interest rates. Those gray bars that you see on our chart there indicate some type of economic crisis. You can look at the 2008 housing crisis. Obviously, that lasted quite a long time. But I want to look a little bit closer at this gray bar here because that represents the pandemic, right? And I think it's important to understand as future buyers that the rate levels that we saw in the pandemic, the 2.5% levels, are not realistic as something we should anticipate at some point in time. Because if that does occur, that means something catastrophic again has happened globally to us, and we obviously don't want that. But I think as we look at our timing of buying, historically interest rates are going to be in the high fours to low fives. That's generally what we see. And we're still above those levels, but we are seeing interest rates go lower. And obviously it's economic or data dependent, but it's not a if interest rates will go lower than they are today. It's more of a when type of situation. Now, everybody wants to time the market. Everybody wants the lowest priced home. Everybody wants the lowest price rate. Very difficult to do that. Just ask some of the folks that purchased during the pandemic when interest rates were at 2.5%. They also had people that were trying to outbid them on homes, 30 and 40 offers on one home. Now, we don't see that today, but ultimately, there is a need for more inventory still in the market, even though there's a little bit of a backlog. I think as we see more buyers enter the market, which we're already seeing that today with interest rate levels dropping, it'll be interesting to see how this housing market shakes out and maybe levels out versus seeing some of the declines that we have or backlog of supply in some markets. All right, now for interest rates, they're not the same for every buyer. There's various elements that go into interest rate, things like credit score and the eligibility for a specific program, the product that I want to take advantage of, how much I decide to finance, what type of property I'm going to finance, how many units am I going to try to finance. So if I buy a condominium versus a single family residence, the pricing of that could look a little bit different. Or if I'm going to buy a 3-unit property versus someone buying a 1-unit property, that can also look a little bit different. And the down payment that I elect to make on my home purchase will also change things. Now, some clients will elect to do what we call as discount points, where they're essentially paying money out of pocket to bring down their interest rate. Not something we would advise our clients do in today's market because it usually takes about 3 to 4 years for you to break even on those investments. So not something we totally would recommend. And then the term of my loan can also determine what my interest rate looks like. So if I can shrink my term down a little bit, so traditionally we look at 30-year mortgages, but if we go down to a 15-year mortgage, that could also reduce our interest rate. So, as I get a chance to meet with our clients for a home buyer's consultation, we're going to figure out what the right product design looks like for you. So, maybe it's a 20-year product, maybe it's a 30-year product. We'll just have to see based upon budget and goals and, kind of where we want to see ourselves long-term in this home. That's kind of fits how we kind of design our products. All right. Now, as we think about designing options for clients, we're also going to take a look at credit because credit plays a major role in the cost of borrowing for a consumer. And so every loan product does have a minimum credit score, and you can see those displayed on screen here with each one of our core products here. So those are the minimums. Our goal is to get to the highest credit score possible because the higher we get our credit score, the lesser my borrowing costs are going to be. Things like my interest rate will be less. My mortgage insurance that I pay for when I put less than 20% down, all those things will be less expensive when I have a higher credit score. Now, as we all know, there's 3 different credit agencies that report out to us as consumers. There's TransUnion, there's Experian, and there's Equifax. Now, each one of those agencies have different models to how they look at risk for credit. And so there's a credit card model, which that's, by the way, what you're going to see in most of your monitoring tools that you get. There's auto, which is going to be for someone that's applying for an auto loan. And then there's the mortgage side of things. So if you're applying for home financing, there's a different risk model for that as well, too. All right. Now, in credit scoring, from a mortgage perspective, we always look at the middle score of all 3 agency reports. So if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, we're going to take 740 as the middle score for qualifying purposes. Now, let's say I'm going to apply with my partner, and my partner has slightly lower credit scores, and they're at 720, 700, and 680. Well, 700 is the lowest score between the two of us. So the 700 score is going to be what's used for qualifying purposes. So that could impact interest rate, product selection, like I said, mortgage insurance. So we want to be very strategic in how we work with you on credit and try to see how we can optimize the best way to set up your financing for you, essentially. All right. Now, as we look at maybe past events on our credit report, let's say I had a collection that appeared on my account, or maybe I had a late payment. When those events hit your credit report, it's going to impact you most recently in the most recent 12 to 24 months. Okay. Now, as the further we get away from those events, we're going to start to see organic improvement in our credit score. Now, we're going to talk about things like credit utilization and whatnot as part of kind of looking at the modeling of a mortgage score. Let's take a look at just a quick matrix that I want to pass along to you, because if you've had any credit challenges, this is how long they're going to appear on your credit report. Now, the impact to the score per se is going to be in the most recent 12 to 24 months, but this is how long it will image on your credit report for. So if I had a late payment on a student loan back in 2020, it's still going to be on my credit report, probably not impacting my score as much because we're at 5 years. Still shows there because it's a 7-year time period. But as I get further away from that event, the more I'm going to see improvement in my credit score. All right, so let's talk a little bit about the FICO score model as it relates to mortgage. And I would encourage you that as I go through each area, maybe think a little bit more about your own specific credit situation and might be the area of opportunity for you as you're kind of looking at or preparing for homeownership. So we'll kind of go around the wheel here really quick. I'll just kind of explain to you each category. So 15% is going to be the length of credit that I have. So the more mature or seasoned my credit profile is, the higher my credit score is going to be. So if I have someone that's have 6 months of credit history versus someone with 6 years of credit history, as you can imagine, the one with 6 years credit history, assuming all other things being equal, will have that higher credit score because it's 15% of the weighting. 20% is going to be how much new credit am I trying to get access to? So if I'm going in and opening a bunch of new accounts, if I'm having creditors run hard inquiries on my credit, that is going to impact my credit score by 20% of the weighting. Now, one of our approaches to working with our clients from the credit perspective is we only start with pre-approvals in our consultation with a soft credit check. And the reason why we choose to do that is because our clients generally are going to be buying on a longer cycle time. So we want to give you the features and benefits and design of a home buying plan without impacting your credit score. So we always start with a soft credit score. Most lenders, when you decide to get pre-approved, are going to do a hard inquiry. And I just don't believe in that because everybody's going to have kind of a varying times of when they want to pursue home ownership. Now there are rules in place in home ownership and auto financing that say this is that once you do have someone that does want to do a hard inquiry, once they initiate that hard inquiry, you have a 30-day window of time to shop around with many lenders as you'd like. All right. But in our process, like I said, we do a soft credit check. Now, kind of continuing around to the 30% weighting, that is amount owed or credit utilization. So we're looking at credit card or revolving balances versus what I have as a credit limit. So very simply, if I have $10,000 in credit limits, I have $5,000 in balances, I'm currently at 50% utilization. Now, if I've kind of pushed up my debt load a little bit and I'm now at $8,000 in balances, we would recommend in our credit coaching for you to at least get below $5,000 because that'll give you some incremental lift in your credit score. But if you're trying to optimize your credit score, you really want to get that balance to below $1,000 in that example. Here's how I'd encourage you to manage down credit utilization. There's on your credit card statement, there is what we call a billing cycle or closing date or statement date, depending on the creditor, they'll call it different things. But ultimately, that's the date at which the creditor closes out all your activity from the preceding 30 days. And what they do is they report all that information out to the agencies, balances, credit limit, pay history, all that fun stuff, right? Well, if you can pay down your balance or ideally pay it off before the end of the statement date, what happens is you're going to have better data that goes out to the agencies, therefore improving your utilization of credit and then lifting your credit score. Highly encouraged, especially if you're getting ready to apply for any type of loan, whether that's home financing, auto, whatever the case may be. All right. Last section, pretty self-explanatory, but how have I paid my bills? Payment history, and that's rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. To my earlier point, we're looking at, or the model is looking at your evaluating your history, especially over the last 12 to 24 months. If I have a late payment, it's going to stick with me for 7 years. All right. So, late payments can really zap the credit score very quickly. It does take some time for recovery, but those are certainly things that we can talk through during a consultative session with you. All right. So kind of transitioning or maybe staying with credit to a certain extent is student loans. Okay. So we're going to talk a little bit about student loans because that is part of my conversations with many clients is, hey, where am I currently at right now with my overall debt load? But as I look at my student loans, whether I'm in repayment right now or not, it's something that I'm going to have to obviously, take on as debt, as a monthly debt at some point in time. Now, if I'm currently under a savings plan or income-based repayment program, and let's say I owe $75,000 in debt and my payment's $250 per month, we can use that payment right away for qualifying. However, if I'm in forbearance right now because maybe I'm still, coming out of maybe a relief program or whatever the case may be, or let's say I'm in deferment because I'm back in school working on my master's program, whatever the case may be, if you do have no active payment on your student loan, then by default, we do have to count a minimum payment based upon the program we're going to select. So if I'm looking at a conventional loan with that same $75,000 in student loan debt, then we apply a 1% rule, which is 750, of course. And then for an FHA loan, it would be 0.5% or 375 for that same level of student loan debt. So, that's really important because, as we explore options for clients, we do have to factor in a monthly payment for student loan debt. It's based upon the guidelines that are applied for in different loan programs that lenders offer you. And so as we take a look at those loan programs, I just wanted to kind of give you a 10,000 foot view of some of the core programs that are available to you. There's obviously many different options available to you as buyers, but I thought it'd be important to kind of tie together some of the most common products utilized in our support for first-time buyers. So the first product is a conventional loan. So you might have heard about a conventional loan because that's a Fannie Mae, Freddie Mac loan. Of course, those agencies got a lot of attention during the housing crisis of 2008. They're currently under conservatorship by the U.S. government, and there's talk about them going private in the news. You'll see a lot of that right now. But Fannie and Freddie have various guidelines that we adhere to as a lender. The minimum down payment for a first-time buyer is 3% of the sales price, up to a maximum loan amount of $806,500. We call that the conforming loan limit. That loan limit gets adjusted every year right around this time. In fact, they just adjusted it, I think just up to about 812, maybe 816. That's just based upon changes in cost of living. And so we'll see that adjusted every year. Now, for those of you that are in high cost of living areas, some of us in the Virginia market, maybe we're in New York or maybe we're in California, there's what we call high cost of living areas where we can go up to $1,209,650. However, when we exceed that conforming loan limit that you see on screen, the minimum down payment jumps from 3% to 5%. All right. The FHA loan, that stands for the Federal Housing Administration, not just for first-time home buyers. Anybody can participate in the FHA loan. 3.5% minimum down payment. The maximum loan amount will vary based upon where in the country I'm going to purchase. So there are county limits for FHA depending on where I'm seeking to purchase. Now, I want to kind of tie together both FHA and USDA because those are both government insured loans. There was some changes made with government insured loans as it relates to residency history or residency status, I should say, which says this, that in order to access both FHA or USDA, I have to be a permanent resident in the US. And unfortunately, those changes were made that impacted some of the eligible buyers. Now, even if I'm a non-permanent resident, I can still participate in the conventional home loan. But unfortunately, on any type of government insured loans, you do have to be a permanent resident. Now, as we mentioned, USDA is a government insured loan. Now, USDA stands for the United States Department of Agriculture, as we all kind of know. But what they do is they warrant loans that are being purchased in rural areas. So if I want to purchase in a rural area, as long as I meet the income limits, it fits the location for USDA. That gives me a zero down payment option. The maximum loan amount, it's very similar to FHA, varies based upon what county I'm going to purchase in. The jumbo loan, I'm just going to quickly highlight, it just allows clients that need a little bit more bandwidth in their qualifying to purchase that stretches beyond some of the agency limits. But it does come with it a higher level of down payment, usually 10 to 15% down, and higher credit score requirements. And then finally, the VA home loan, that's for our veterans that have eligibility to purchase under the VA product. It's a great tool that provides the veteran access to home ownership, zero down payment option, lower credit score requirements, a little bit more flexibility in the qualifying, and there really is no maximum loan amount for the VA home loan. Now, in some of our classes, beyond these guidelines, the type of property that we're looking to purchase sometimes comes up. Some of our first-time buyers looking to purchase investment properties or multifamily properties. Just as a quick side note, generally when you buy an investment property, it's a minimum down payment of 20% in most products. And I should say, if you're looking at a multifamily product, so anything from a 2-unit to a 4-unit property, it does have at least a minimum down payment of 5% on a conventional loan or 3.5% on an FHA loan, assuming I'm going to occupy one of those units. All right. I'm going to take a quick pause there because we're going to talk about private mortgage insurance and upfront mortgage insurance in just a second, or MIP, I should say. Any questions from our audience that I can help answer for you? I know I rattled off a bunch of concepts to you, but I want to be respectful of your time this evening. All right, I know Ken's answered a few questions already, so Ken, thanks for that. Okay, let's talk a little bit about mortgage insurance. I think there's a little bit of a misconception around mortgage insurance and how it works, how much it costs, all that kind of stuff. Well, there's kind of two different areas of mortgage insurance. One is there's PMI, which stands for private mortgage insurance. The other is mortgage insurance premium, which coincides with an FHA or government insured loan. Now, they both function the same way in that they provide protection to the lender in case there's any default by the buyer. So if the buyer, unfortunately, was not able to make their mortgage payments, the insurance would come in and protect the lender's investment on that particular transaction. Now, with PMI, how we calculate that for a conventional loan, it's based upon down payment, also credit score, and how much I finance. So that's the kind of the characteristics that go into the premium of PMI. Now, PMI has a cancellation option, which basically when I hit 2 years in my home and I have 20 to 22% equity, I can apply to have the mortgage insurance completely canceled. Now, one of the misconceptions I see from a lot of buyers is that they've already started their search on Redfin or Zillow, and they're doing some payment calculations, and they get some wild numbers as it relates to PMI. And for those of us that have, scores that qualify in a conventional loan, depending on what your down payment looks like, the PMI is actually pretty reasonable. And we got an example for you on screen for someone that's financing 450, 740 credit score and 3% down. That's about $138 a month. Now, the higher I can push my credit score, higher I can elevate the down payment, the less I'm going to pay from a mortgage insurance perspective. FHA looks a little bit different because FHA has two forms of mortgage insurance. There's upfront mortgage insurance, which is 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my loan amount. Now, the FHA loan does not have a cancellation option. So essentially, when I'm in that loan, if I'm going to try to cancel mortgage insurance, really the only way to do that is to refinance out of the FHA loan into more of the conventional home loan. Now, we generally use FHA as that entry point to homeownership because FHA has a lot more flexibility towards qualifying than we would see with a conventional product. So maybe my credit score is a little bit challenged right now, or maybe I have some recent late payments, or I'm a little bit overextended. FHA is a great launch into homeownership to allow us to get access to homeownership. And then when the time is right, we've seen some improvement in credit or expenses, we can then look to refinance into more of a conventional product. Here's what the example looks like on FHA. So we take that same 450 loan amount. We do have to add the upfront mortgage insurance of $7,800 a month, plus the monthly amount of $206. It is going to be a much more costly option with FHA, but I think it's just important to understand as a class is that, not everybody's going to qualify in conventional loans. So we want to be able to obviously have an alternative or another option for our clients in accessing homeownership. All right, let's kind of keep it moving. I want to talk a little bit about income. Some different scenarios that we come across in designing options for clients. I get a lot of questions that I want to share back with our audience tonight. Before I do that, though, I do want to share with you some of the documentation that we generally will ask for in the process. So as you decide to work with us to build your home buying plan, this is generally some of the documents that we would ask for as getting you prepared for your pre-approval and your plan for homeownership. So that's what that looks like. Now let's talk a little bit about some of the requirements around employment because there's a lot of misconceptions out there. And so when we look at our history of employment, we can also factor in education. So as a lender, we verify 2 years of history of employment and/or education. So we can combine those two to make up the 2-year requirement. So if I just graduated just recently, let's say in the spring, and I started my new job August 1st, I can still qualify for a mortgage by combining maybe my undergrad at UVA plus my new job history to make up that 2 years requirement. All right. So you can even have scenarios where you're getting ready to transfer from one job to another. I don't necessarily have to be on that new job a certain amount of time before I can get access to home financing. Here's a great example. Just today, in fact, we had a client that got the keys to their home. They didn't start their new job until today. We got them fully wrapped up with their funding just this morning, but only just started their job today. And we had qualified them and everything with their executed offer letter. So as long as we have an offer letter from an employer and eventually get a non-conditional offer letter, so you passed your background and everything, you can qualify for financing and purchase your home with as little as that offer letter. So a lot of people don't realize that. Now, when we think about sources of income, like let's say I have a base salary, but I also have variable sources with my employer. Let's say I have RSUs, or I have overtime, or I have bonuses, commissions. Those are generally variable sources. RSU, by the way, stands for restricted stock. And some of our clients that are in maybe the tech industry or startups get a lot of RSU options. Would we have alternative sources like that? As long as I'm with my employer at least 2 years, then we can use those additional sources to factor into income qualifying. So for example, if I earn bonuses, I make $10,000 a year in additional bonuses, I can average the last 2 years of earned bonuses into our income calculation. Now, if I have multiple sources of jobs, so let's say I work for 2 different employers, if I do want to count both sources of income, then I have to show that I've been with both employers for 2 years. All right. And then if I'm self-employed, so I earn a 1099, maybe I'm an independent contractor, but I file a Schedule C as a sole proprietor, whatever the case may be. In that case, that's where that 2-year requirement stands, where I have to show 2 years of tax filings for eligibility. All right. And then a couple of things I just want to kind of add into the conversation. If you have additional sources of income, like let's say, for example, your partner contributes to the household income, but is not going to be part of the loan application for whatever reason, we can't count that income unless it's someone that's going to join you on the loan application. Okay. And then last thing I want to touch on is if I'm working 40 hours a week on my job, but I'll say I also drive for Uber or Lyft on the weekends, and I really want to count that Uber or Lyft income, well, they're paying you as a 1099 team member. In order to count both sources of income, I do have to show I've been on both jobs simultaneously for 2 years. All right. Any questions about income verification or scenarios I can take from the class? Because we're going to talk a little bit about expenses versus income, but before I jump over there, I want to just make sure I don't have any questions from the class that I can answer. Okay, so we'll keep it moving. One of the calculations we do as lenders, it's called debt to income ratio. You might have heard about it. Essentially looks at your existing expenses that you have today, things like credit card debts, student loans, auto payments, along with your projected housing payment. And then we compare that versus your pre-tax income. So if I was to look at a scenario like we have on screen, someone that's going to have principal, and I'll explain these acronyms, principal, interest, taxes, and insurance of my new home, plus I'm paying PMI, and I have homeowners association dues of $2,500 a month, right? And my other debts are $500 a month. So that person has $3,000 of existing or projected expenses, and they make $8,500 a month. The expenses versus income would be essentially 35.3%. So we're evaluating how much of those expenses consume the income on a pre-tax basis. Now, the highest we can look at as a lender is 45 to 50%, but the sweet spot I find with most buyers is going to be around 33 to 36%. That would be considered excellent. But I do understand that some people may be higher on the debt to income ratio spectrum just because maybe they have income that we can't validate. Maybe to my earlier example, we might have a partner that's contributing to the income of the household, but doesn't necessarily want to be on the loan. All those things, obviously, we put into the calculation. Now, ultimately, this is just a measurement for qualifying. What's more important to us is just measuring affordability. And that's obviously a big challenge for many of us across our communities that we serve. But we want to talk more about like, what's the budget need to look like? If I'm going from $2,000 in rent to $2,500 in mortgage, does that work for me? Is that gonna be something I can really make sustainable for myself? Okay. So that's kind of what we look at, expenses versus income. And that's all part of building this plan for you around homeownership. Now, I want to talk to you a little bit about down payment and savings for homeownership. Before I do, I want to take one of our questions that just came in, which is if you're starting a new job while buying, so will an employment background check ding your credit? It should not. It just depends on how they pull the background. Yeah, that's a good question. It depends on who they're using for their agency to do the background. But my guess is it's going to be a different type of credit report. It probably shouldn't do a full credit inquiry. All right, so let's talk a little bit about down payment and savings for home ownership. So, we've learned a little bit about the minimum down payments that we have to have for home ownership, but beyond that, we need to think also about other expenses that come along with home ownership, things like closing costs and prepaid items to buy my house. So, if we think about our home ownership example earlier, 3% is the minimum down payment. Closing costs and prepaids would be things that we want to budget on an estimated 2 to 3% of our purchase price. So those are the things that we have to save for when it comes to, our home ownership plan. This is the way we would look at or validate those assets. So we would take things like checking and savings accounts. We can't use cash deposits. Assets have to be seasoned for 60 days, but we can also use 401ks, brokerage accounts. Those are all completely allowed in your home ownership qualifying. Gift funds can also be allowed. So that's when a family member is essentially providing their resources to help you with your home purchase. With gift funds, there is no seasoning requirement. So those funds can be used right away. All right. So one of the things that I help clients with in preparing for home ownership is just developing a plan around savings for home ownership, because many clients will come to us ready to go, but maybe they're just not quite there from a savings perspective. Maybe they can afford the new monthly payment, but just don't have the resources available for the down payment. So I like to walk our class through just a really simple approach to savings, and it looks like this. So if I'm currently spending, let's say, $1,500 a month in rent, but with my projected mortgage expense that I feel like I can afford being $3,000 a month, on the first of the month, so that's today. So if you guys have paid your rent payment today, right? When I pay that $1,500 rent payment, I want to create that habit for myself that I now also transfer an additional $1,500 into my savings account. And so essentially I'm paying, like, in reality, $3,000 on the first of the month, but $1,500 goes to my landlord, $1,500 to my savings. What that does, it is creating more savings for yourself on a month in, month out basis. By the end of 6 months, I got $9,000. By the end of 12 months, of course, $18,000. And that doesn't include a high yield interest savings account. So that's a really simple approach. And we've had so many success stories where, and in fact, I have a client that's actively shopping right now that started that last year from class. And now they've saved up a really great nest egg towards their home purchase and are ready to actively start buying. So really encourage you to kind of take a look at that. It is a simple approach, but it does a couple things. It obviously creates the discipline of savings, but it also makes it a nice transition into home ownership. So it doesn't feel like such this big jump going from $1,500 to, say, $3,000 a month in mortgage. Right now, if we're struggling or we have a gap, if you will, in resources to meet some of the down payment and closing cost requirements, all across the country, there are assistance programs offered in each local market or state market. They're generally called HFAs, or housing finance agencies, designed to support low to moderate income households. Virginia is no exception. And because we're teaching a UVA class, I thought I would just pass along some of the Virginia housing program information. You can elect a Virginia housing conventional loan with these products that allows you a cheaper interest rate structure, lower cost for you as first-time buyers. You can also get access to grants, 2 to 2.5% in assistance. There's also the Virginia Housing Plus Second program, anywhere between 3 to 5% of the sales price in assistance. So really great resources there to help minimize out-of-pocket expense, and of course make homeownership much more of a near-term goal for you. And then nationally, we have a Pathway DPA program that works for both, or for the FHA product, anywhere between 3.5 to 5% of your loan amount sales price in assistance. I will say, the first-time buyer programs generally have income limits. So they're generally somewhere between 80% to 150% of median income. The Pathway DPA program does not have a maximum income limit. All right. Okay, so I would encourage you, if you do have questions around first-time buyer programs, feel free you can obviously ask me during class today, or we can talk offline about some of the resources that are available to you, because many people don't realize that there is access to homeownership with some really great programs that are available in your local markets. All right, so we're almost to the finish line, but before we get there, I do want to spend some time looking at the workflow of buying a house. It's definitely a big topic of conversation for many first-time home buyers. Like, where do we go from here? So I've attended this class. I got some great, good takeaways. Now, where do I go from here? Well, we would encourage you to get connected with us for a consultation. You've heard me mention that a few times. That's a free service we provide to you, and we meet with you virtually for a 30-minute session. And that's something I do with every client that attends our class. We sit down over Zoom. We build a home buying plan. We talk a little bit about budget. Where do I want to buy? What's my savings need to look like? Do I need to create a savings plan for myself? And then we get you ready to purchase. And whether that's this year or it's a 3-year strategic plan, we want to help guide you there. And so that's a service that we provide to you. Now, when you're ready to go and you want to be pre-approved, that kind of starts us on the workflow that you can see here on screen. So step one in the home buying process is to be pre-approved. So that comes again out of the consultation. Now, a pre-approval doesn't put you on a time constraint to purchase, but generally the pre-approval is good for 60 days, but it can be easily recertified at any time. So you don't have to feel a pressure to go out and buy a house this weekend or something like that. That pre-approval is very fluid. So as you're seeing different properties that meet your needs and lifestyle, then that pre-approval can be adjusted. So you may be pre-approved for 450,000, but the house you really love is 425,000. And so as long as you meet the qualifying parameters there, we can always update that pre-approval to match what you're considering for in offer price. Now, as we kind of move down the workflow, step 2 is house hunting. So that's where we're going out and probably looking at homes online first. Then we'll start going in person as we identify maybe 5 to 10 homes that we really like. We would encourage you to talk to a local realtor that can help guide you in that search. They should be experts in their market, have all the data available to them that can make sure that you're making a good sound purchase. We have preferred realtors all across the country that we can recommend, depending on what market that you're looking to buy in. Now, as you're going through the home search, you're gonna, like I said, identify some properties. Let's say you find the property that's like, that's it, that's the house we want. Then the realtor is gonna help orchestrate the offer for you. And that offer will get submitted to a seller. And we may get the offer accepted, we may get countered, and they may want to counter the terms, or they might say no. And that does happen in the home search process, but hopefully we'll have that home run on the first offer on the home that we love. And when that offer gets accepted, then we move to step 3, and that's called entering escrow. So essentially that means is you have a ratified contract with the seller. On the same day that happens, you get a call from me and our team saying, hey, congratulations, you did it. That's a big, huge step because now you have an accepted offer. Let's walk you through the next steps in the process and get you scheduled for your follow-up video session so I can meet with you to go through all like the design of your home financing. Because based upon the terms and the conditions you've agreed to, we want to make sure that we kind of build the financing accordingly. Now, you will have some action items on your side that you'll be doing on the financing side, but also as part of your contract. In most contracts, you're going to have what we call as an earnest money deposit requirement, which in 2 or 3 days of the contract agreement, you're going to have to make that deposit, which is usually 1% to 2% of your purchase price. Now, that amount of money will count towards your out of pocket for your home purchase, but it is held into an escrow account while you go through the contractual workflow. Now, there are contingencies in most parts of the country that allow you to do your due diligence on the house, get your inspections done, get your loan approved, get your appraisal completed to make sure the value supports your purchase price. But that's usually all part of the contract, and they have varying timelines. It could be short as 7 days, it could be 21 days, depending on where you're at and where you want to purchase, and ultimately what you negotiate with the seller. Now, as we're moving through these milestones, you're going to be getting electronic disclosures from our lending team that's highlighting everything we reviewed during your follow-up video session. Now, I will say an important feature or component to this workflow right now is kind of what the interest rate market is doing. Because once you're under contract with the seller, then we're going to be talking strategically about when to lock in your interest rate. As you heard me comment on interest rates earlier in our market segment, interest rates are moving lower. And if we can time the market for you under your workflow here or in your contract period, we want to try to capture the lowest rate opportunity for you. So many of our clients were looking towards some of the data coming out on Friday. So hopefully we can see interest rates slip a little bit lower for them. Step 4 is going to be the administrative functions of the loan. That's where we're looking at things like verifying employment, assets, making sure the program is all set up properly for you, and ultimately submitting you to the underwriting team to do their final review of everything. And that happens at step 5. That also takes us about 2 weeks into the escrow time period. Usually from accepted offer to getting our keys, most parts of the country, it's 30 days. It can be shorter. We had comment about, hyper competitive markets and, what's the right down payment. Some markets we close as fast as 14 days because we need to, but most markets across the country, it's about 30 days. Now, step 5 is loan approval. We also gets us to about 2 to 3 weeks into the process. We've gotten disclosure sent out to you. We'll also send you your final closing disclosure at this phase. It also gives you a 3-day cooling off period before we go to the very final milestone, and that's called the closing of the loan. And that's where you need to be in person, other than, of course, being in person for your inspections and your home search. But that's when you sit down with either an attorney, escrow officer, or a public notary to sign your final documents. That takes about an hour or so, for that process. And then that same day, you'll be depositing your final funds owed for your home purchase. We also wire in the funds for your home financing that day. Those monies get all kind of balanced or reconciled by the escrow team, and then they record documents with the local county recorder's office. They record a grant deed to transfer ownership and the deed for the loan. And once that gets all confirmed, that's on record and recorded, then you become the official owner of the home. Huge, huge, huge day, huge accomplishment. This morning, I got to start my day by congratulating one of our new buyers in Northern California. Super exciting moment for them and their family. And hopefully we get to do that same thing for you at some point in time. Well, our relationships with our clients don't stop there. As we kind of, continue to move down and take on home ownership, we have our aftercare program that we're going to continue to support you with, giving you tools like our Rate Watch system to evaluate refinance opportunities at some point in time, our HomeBot system to evaluate your home equity, and always checking in with our clients just to see what's happening with them financially. Because let's face it, things are always changing for us financially. We want to make sure we're here as a resource for you. All right. As we kind of wrap up tonight's class, we got a few minutes before the top of the hour. I just want to give you kind of the links to start the process. If you're thinking about working with us to build your home buying plan, I wanted to pass along our get started information. Really simple process. It's a simple online application. Just again, we only start with a soft credit check. You can upload documents, and then you'll use our scheduling system, which you can see here, to schedule your virtual session. Now, if you have some questions as a follow-up after tonight and want to just connect with me for an introductory call, love to be able to meet with you, answer some questions, maybe a scenario that you have that I can help you with. We want to just be here as a resource for you to really help guide you down this path towards home ownership. And then this is kind of what a consultation looks like for you, just the basic framework of everything. Again, it's about a 30-minute session for you, but we really want to understand budget, where we're going to buy, what resources, like maybe first-time home buyers that we can, programs that we can help you out with, all the tools that you'll need at your disposal. Speaking of tools, we really embrace technology, so you can start all this process via mobile. You can also follow the progress of your loan. You can use our calculator function. We really embrace technology with our team here at APM. We also use AI to help better support our clients, but it doesn't replace the human touch in this major purchase for you. So we're always available via email, text, call, because we want to make sure you have all the information at your disposal. And then finally, as part of our awesome partnership with the UVA alumni, we want to just make sure you're aware of our discount program. So we discount our services in partnership with UVA. Also, you obviously have access to the class like you're attending tonight. We teach this 4 times a year. And so we would encourage you, if you have friends, family, or coworkers that might really enjoy some of this content, feel free to pass along either the recorded version, or they can attend one of our live classes that we have still left on the 2025 calendar. All right, and then last thing I want to do is just kind of pass along my information. So if you do have questions, you want to connect with me, here's all my personal information. Feel free to send me a message, call me if that works better for you. Love to be able to stay connected with you. And we love what our communities say about us. We really believe that's a really good reflection of how we treat our customers. So we would encourage you to check out and see what people are saying us in our local communities on Reddit or some of our Google reviews, because we understand, how big of a move this is for all of us attending classes like this. And we want to make sure you have the right partner to help you along this journey. All right, well, that takes me to the end of class. We have a few minutes left. I saw, we have most of us still staying in class, but I saw some questions kind of popping in. I think Ken was helping out with maybe a few of those. Let me just take a look at that last question that came in. If you do have some questions before we wrap up, love to be able to answer those for the rest of the class. Let me just answer this question on air. I know Ken answered it for the individual, but let me just kind of throw it out to the whole class, which is, can you use these resources if you're trying to bridge from 10 to 20% down payment, or just to get to the initial 3%? So I think they're referring to first-time buyer programs. So you can absolutely augment your down payment with first-time buyer programs. So If you've really worked hard to get to 10%, but you would love to get to 20% or 15%, whatever the amount is, you can use first-time buyer programs to help get you to that next level of down payment. Of course, finance less on your first mortgage and ultimately improve your monthly outgo. So that's absolutely allowed. Some first-time buyer programs will have restrictions on assets, so we just got to be mindful of that. So we can't have a bunch of assets sitting in a high yield savings account and we're not using those for the purchase. Some first-time buyer programs, not all, will want to know a little bit more about your asset position. All right. Great questions in tonight's class. I really appreciate your engagement. I'll throw this last question in here, and then you guys can obviously ask me anything else, which is, do you include monthly credit card bills or rent payments in the debt to income ratio? So we do not. The minimum credit card payment that you have that reports to your credit card, the credit agencies from your credit card company does get factored into debt to income ratio, but rent payments do not, because the assumption is that, when I buy my new house, my rent payment goes away. Now I take on my new mortgage payment. If you are in the habit of paying off your balances on your credit cards every month, which many of our clients do, then we will kind of put that into our calculation and then remove those minimum payments, because if you're paying after the billing cycle date, you probably have a balance showing up on your credit report. But if you pay it off on the due date, then we can exclude that from the debt to income ratio. All right. Okay. Any other questions from class before we wrap up tonight? All right. Well, you guys have been an awesome class. I do appreciate everybody's participation. We will send out our slide deck tomorrow morning, which is all recorded. It'll be up on our YouTube channel. Feel free to share that out with anyone in friends, family, coworkers. We'd love to be able to have them use this as a resource. And I hope I get a chance to connect with you to help you on your journey towards homeownership. Have a wonderful Wednesday evening, and I hopefully talk to you soon. Good night.